Thank you for that very kind introduction. I wrote it, so I'm very familiar with it. But good morning, ladies and gentlemen. I'm very honored to be back here speaking on molybdenum for Metals Pages Conference. The title of this presentation is Assessing the Implications of China's Soft Landing on Both Domestic and Rest of World Supplies. Over the next couple years, some of the major concerns that we've had in the molybdenum market, they've eased a little bit. And so our outlook for the next 3 years seems to be fairly balanced. But there are some dramatic changes that could occur over this time period that could really influence our outlook and our underlying assumptions. So I'll make note of those and talk about what we think prices are going forward. Disclaimer, we can go through that. And you've already introduced CPM Group, which is primarily a commodities consulting and research group, and we really do have a flow of research analysis to our other arms, which are financial advisory and commodities management. We've been around for some time now, since 1986, so we have quite the expertise in the sector. So let's just get started here. I know most of you are really familiar with molybdenum pricing, but I wanted to put it in relative terms to some of the other base metals, as well as some of the metals that are considered critical. These are metals that are facing mining and export restraints out of China. All these index pricing, it's all relative about what year you index them. I chose to do it since the recession, and since that, molybdenum has performed better than other markets like cobalt, which we'll get to later, but it has trended more in fashion with some of the more oversupplied markets like aluminum and zinc. And then on the right-hand side, you can see index molybdenum prices with some of these critical metals, and moly prices, they're at the bottom, so you can find them, even though it's kind of hard for you guys to see back there. But this is not historically the case for molybdenum prices. We've actually seen China having quite the influence on pricing. This is not intended to give you the 101 on molybdenum pricing, but I'll just kind of go through some of the main drivers we've had historically. And you can see we've had also tremendous price gains, 12-fold increases that wasn't reflected in that index price chart. But right here, starting in about 2004, we had insufficient roasting capacity and really robust steel demand pushed prices higher. We had in February 2005, China closed mines in the Hudalau area, which sent prices up to about $40 in June 2005. Then we've had kind of this series of tighter export policies out of China, both on ferromolybdenum and oxides, and continued tightened regulatory policies, which drove prices higher over the next couple of years. But with really all industrial metals, we saw this sharp decline, and this is in September 2008. Molybdenum prices lost about 3/4 of their value, hitting a trough of about $770 in, I think that was April 2009. But with molybdenum prices below the cost of production in China, we saw China switch over to a net importer of molybdenum, very positive for prices. That and fiscal stimulus in China contributed to that robust demand, and prices continued to edge higher. Most recently, we had last year, just about the time of this conference, we had prices peak out about $19 a pound. And then it was, we had the earthquake in Japan. We had kind of some, sluggish steel markets, and pretty much the European debt crisis weigh on prices. We have had a little bit of uptick in early 2012. Some of the uncertainties in the first 2 months of the year about, politicians' ability to address the solvent debt issues in Europe were slightly, put at ease. And then we also had manufacturing in China pick up, and that helped prices rebound up towards $15. We're actually going to go through, this is the presentation outline. Over the course of this presentation, I'm going to talk about some of the topics that were really driving prices higher. We'll begin by looking at China. Then we'll talk about the role byproduct supplies have had on the market. We'll look at the potential for new supplies to come on. And then I'll switch over to fabrication demand. And, molybdenum is really leveraged to some of these high growth markets, and that has had a really positive and negative effect on prices at times, as you saw on that last chart. And then I'll end by looking at the price outlook and the supply-demand balance. So in this chart here, you can see the supply breakdown. This is by country, and then this is contributions to supply by some of these leading producers over time. On the supply side, China is the largest producer, and they're accounting for about 35% of supply. They became the largest producer in 2007, and they were surpassing the U.S. at that time. And what led to that was just really robust growth rates. Over that time period, we saw almost 25 to 50% growth rates in Chinese supply. And so all this rapid growth in Chinese supply really did prompt the Chinese government to tighten their reins on the overproduction really for the export market. In 2011, this is for the second consecutive year, we had China's Ministry of Information and Technology. They issued a mining quota. It was roughly 198 million pounds, and we do think that mine production actually came below that level, about 9 million pounds shy of that, and that's really due to, softer prices comparably to what we've had historically. So these mining quotas haven't had a significant influence on mine production, but we do think going forward that there are two policies that are in the development that could have a more significant influence on supply growth. And so this chart right here, this is the contributions to total molybdenum supply growth from China. So how much China is contributing toward the growth. And you can see from 2006 to 2010, they were accounting for nearly all the growth. But going forward, we see much less growth coming, a contribution to growth coming from China. And part of that is related to these policies. The first of them is expected to be released from the National Development and Reform Commission, and that's going to go ahead and have some implications on restricting mining and smelting projects. The second is from the Ministry of Land and Resources, and this is a little bit more, it's got a much more significant influence on supplies going forward. If they reclassify molybdenum as a national resource, that would really thereby have a limiting effect on the development and expansion of new mining projects in China. These policies have already been drafted, and they are really in line with the 12-year plan, 12th five-year plan out of China. So, we've seen that these type of policies in China can really have a lot of influence on pricing. You saw in that historic price chart, most of the big drivers were policy changes in China. And so we do think, given China's market share, that this is really kind of positive for prices, but it's not necessarily going to happen immediately. We don't think that we're going to see necessarily reduced supply growth coming out of China in the very immediate term. In 2011, we had about 8% growth in Chinese supply, bringing it to about 190 million pounds. This year, we are expecting somewhere around 6 to 7% growth. And really, with our outlook on prices, we do think that China will still remain a net exporter, and the new quotas won't really cap growth. One of the things that we've seen is China's been facing a lot of international opposition towards its export policies on some of the minerals. And I think it was June last year, the World Trade Organization announced that it was found China in violation for its export taxes, quotas, and minimum export prices on a certain amount of commodities. China appealed it. They lost the appeal, but again, they are facing some international opposition for these policies that have directly related to exports. So this chart here kind of talks about why we don't necessarily think that these policies that are pending in China are going to have a significant influence on price, at least in the immediate term. This chart here shows kind of the implied market balance for the market, and you can see supplies shifting from the rest of the world to China, really picking up in 2008 and 2009. That was that kind of increase in imports, and China becoming a net importer. And this implied balance shows that there could be, over the past 11 years, it could be roughly 150 million pounds of moly in China. That's less than a year's worth of demand, and it's not as bearish as it sounds because a lot of it's held with kind of more strategic long-term market participants, but it is still keeping kind of this cap on prices. But at least on the downside, there is a pretty significant support there because this chart here is an arbitrage between U.S. prices and Chinese prices. And it really does show that there's a firm floor price in China, and that's really supportive of prices going forward. And that's based on the cost structure. Really, the domestic prices in China, they fell below the $12 to $13 range, and China became a significant importer at that time period. And since prices have really held at that level, and that's really because, you know, that's right around the cost of production in China. That level is actually just recently increased because in February of this year, China just increased their resource tax on molybdenum. So effectively, depending on what your grade is, but it boosted about the total cost about 30 cents a pound. So we do definitely have a rising cost structure in China. And that is, you know, that type of policy that we just saw, that's the type of policies I think that we'll continue to see, policies that are focusing on production and less so on exports. But we do think that China will be an exporter in 2012. So besides China, one of the other major contributors to molybdenum supplies is byproduct supplies. Historically, the market's really relied on byproduct supplies. We have in the 1980s, you know, about 70% of global production was from byproduct producers. That's been declining, and over the past decade, it's averaged about 56%. But, you know, there's periods where mining companies have high graded. Sometimes it's related to, you know, higher prices, and that can lead to a temporary surge in production. But that is temporary. Actually, last year we did see a pretty significant supply response, and that wasn't really related to prices, but more to ore grades and to recoveries. And we saw byproduct supplies jump about 14% in 2011. That compares to about a 3% increase in supplies from primary producers. So for the year, we had total supplies about 546 million pounds. And going forward, supplies from byproduct producers are expected to keep the Western world in balance. So we don't think that there's going to be any significant excess of supplies, maybe until 2015. And much of the supply coming over these next couple of years is from probable projects. Going forward, you know, immediately we have the restart of Climax coming on in late 2012. And then going out, we have this surplus that might arise in 2015. And I want to put this in context because, one, this is where companies are targeting to come on, and I can guarantee you this is capacity, not production, that all this will not come on in 2015. And this is also a temporary kind of projects that are gearing up to try to come in on that window. It doesn't look like this going forward beyond 2015, but we do have this increase in byproduct supplies, which could be a little bit disconcerting for the market because they seem to be a little bit less in tune to pricing than the primary producers. We saw that in 2009, which was the recession where byproduct supplies increased, but primary supplies dropped about 15%. So it's going to matter a little bit on the kind of the producer discipline, but this is what the market's looking at. So it looks like there's a lot of supply. Whether or not this comes on, I don't necessarily think all of it will, but the reason why there's not the same kind of immediate concerns maybe there was 2-3 years ago is because there could potentially be this, but this is also dependent on whether or not prices, where prices are over the next couple of years. So we had, looking at demand, we had a kind of a weaker than expected growth in the global economy, and the second half of 2011, you see expectations, and then this is January 2012 expectations, and this is September 2011, so definitely a downward revision. But there are some indicators that are looking, more positive to say that, towards the second half of 2012, we might be a little bit more stable. But, unlike some of the exchange-traded base metals, molybdenum and some of the, metals that are still, primarily based on the fundamentals, we're not going to have the same forward-looking investment demand that's going to be pricing this in ahead of time. So we're going to see molybdenum prices really respond to the demand volumes when those pick up. Steel production is kind of a leading indicator into industrial production, and we've had that correction in steel production in late 2011. That we think is really foreshadowing this decline in global industrial production, which we think is about roughly half from 2011 levels to be a little bit more than 2% in 2012. So in this medium term, we still think that some of the problems that kind of plagued the market financially, economically, and politically are still present, but there is the possibility of some fiscal stimulus that could actually, shift the balance in favor of industrial metals in the nearer term. So this is molybdenum demand, and this you can see molybdenum demand broken down by country, and then for the past 5 years, growth in molybdenum demand is really come at least 50% to nearly all of it has come from emerging markets. But the market share for molybdenum demand is still in the hands of the more mature markets, which have about 50% of the market. Part of that is because there are much more intense users of molybdenum, and here you can see per capita consumption, and Japan is towering above the others. But you can see there's been really tremendous gains in China over the past 10 years. Here you can see that molybdenum is really highly leveraged to the steel market. This is about 70% of demand. And here you can also see our outlook for the various sectors. So this is the CAGR of the different sectors, steel, non-metallurgical, other metallurgical, over the next 3 years. And to meet this growth expectations, we're going to need to see new supplies, and we have, to meet this growth, it's about 25 to 33 million pounds per year. So that's 1 to 2 primary projects a year that need to come online just to meet demand over this time period. And these are fairly conservative growth rates when you think about what we've seen historically. Even what we've seen in 2011, we had almost 9% growth in molybdenum demand in 2011, even though the markets were as sluggish as they were. And 2012, we think that demand can get up to about 545 million pounds. That's about 4.8% increase year on year. Beyond that, we have demand growing under 6%, nearly 6% for 2013 and 14. And really the strongest sectors in that, we have the stainless market really being the strongest growth out of the steel market. And now the non-metallurgical, it's the catalyst markets, just really the strongest growth function there, and super alloys on the metallurgical. We continue to see the energy sector really being a major driver of the molybdenum market. It's about 20% of global demand. And we've had the construction of power plants, oil and gas pipelines, LNG terminals, vessels. We've had also the exploration and production equipment. They're really all kind of bullish for the molybdenum market. But in North America, we can see, there's been pretty robust investment activity. And that's, we've had oil prices, again, over $100 and staying there for some time period. And you can see this is the Baker Hughes oil rig count. And it's just, since the recession, not only has it been trending higher, it's just been hitting record highs since then. One of the other markets that we're really watching is the North American natural gas market. Because of the development of horizontal drilling, there's some really major technological breakthroughs that are leading to a number of new pipelines and infrastructure that is being planned. But as you can see, lower prices hasn't had quite the same performance in terms of the Baker Hughes rig count. Here we go. Talk a little bit about super alloys, because that was really one of the outperformers in 2011. Comparably to some of these other markets, this is a market where we really have long lead times that continue to influence buying patterns, regardless of some of the cyclical swings that you see in the market. And so, large aircraft manufacturers have started to roll out these new models, which contain really much more higher value material. If you look at where they were in terms of aluminum alloys and titanium and steel alloys, and compared to where they've been in the past. And right now there's about a 6-year backlog in production. So there's continued pretty strong growth coming from that sector. Aerospace is about 4% of molybdenum demand, and it really is more than like a quarter of the super alloy demand. So for our outlook, we think that in 2012, supplies for molybdenum, they're going to be fairly flat. We do have some expansions at existing producers. We have the restart of Freeport's Climax mine in the later half of 2012, and that's offsetting some of the declines that we see elsewhere. We do think that output in China can continue to grow, but pretty much we don't have significant supply growth at all for 2012. So the market's going to be fairly balanced. You can't really see anything there because it's balanced. As new expansion projects start to ramp up in 2013, we do think the market's going to move into a pretty narrow surplus. But you can see here, if you look at inventories and relatives and months of demand, they're continuing to decline. So we have prices picking up from the average of 2012, which is about $15 in 2012, rising to about $17 in 2013. And I just kind of want to mention one more time that some of the policies in China, they've really been catalysts for prices going forward. So if we do see more aggressive policy development in China, which we're not really expecting for 2012, but if we do, we could potentially see prices get up to resistance levels around 1850 at that level. But longer term, we do think there will be an enforcement of these policies that is positive for prices, because China can't be that swing producer that it's been in the past. You remember seeing that contribution to growth, would surge in China in 2006 to 2010. They were really swing suppliers, and these new policies will kind of limit their ability to be that producer. So we have $17 in 2013, and then getting up to about $18 in 2014. This next slide is on the LME contract, but I know Chris Evans is going to do a great job discussing that later, so I'll let him cover that market. Some of the ideas I presented today, they're in our research. We do, on the special melody side, we do this in-depth outlook on molybdenum, vanadium, manganese, just to list a few. But if you have any questions, I'll be happy to speak with you guys afterwards. And right now, I'd love to open the floor to any questions you might have now.
Thank you, Catherine. Do we have any questions?
Yes.
Marcus at the front there. We've got a microphone here.
Maybe I don't need it. No.
You want to shout?
Okay, thanks, Catherine. My question is to the demand side. You've shown, first of all, you said that energy is very important on the demand side, and you've shown that extreme jump in the Baker Hughes rig count. I think this number, and correct me if I'm wrong, includes all the rigs for shale gas. Is that right?
I think it does, yes. Mm-hmm.
It does. So that's probably. So what impact does the shale gas and fracking have on molybdenum? Are there moly alloys used in that, or is that not moly intensive, so to speak?
Oh no, that could be very positive for molybdenum demand. The shale gas and fracking. That's kind of one of the things that we're keeping our eye out for potential strong growth, because not only will it be used in the equipment, the pipeline, it is a market where there is a tremendous amount of infrastructure that needs to be built that hasn't been built, so that infrastructure component as well could be positive.
And is there, we see a lot of resistance in some places in Europe against this fracking. Is in the States, it's all systems go, more investments, bigger growth, or is there more resistance against that as well?
Oh, yes, there's resistance. We unfortunately, or fortunately, you have people really concerned about what this type of drilling might do for their water wells and for their environment. So even though it seems to be a very good source of domestic energy infrastructure, there is quite a bit of opposition that's not just in North America, across Canada as well, against horizontal drilling. So there is a risk component that you have to factor in, and that's why it's something that we're keeping more of an eye on and not necessarily factoring all that infrastructure development into pricing now.
So there's a downside risk that this rig count could fall off a cliff?
Yes. I don't know exactly how much the count itself will fall off a cliff. There would probably have to be a significant kind of reversal in the policy that we've seen. Some communities have accepted it, and it's not a pending development. It is something that is ongoing right now.
Thank you.
Any other questions?
Morning, John Evans on Metal Pages. We saw molybdenum prices reach about $34 just before the crash in 2008. Last year, about this time last year, analysts were predicting between $17 and $28 for the year. Didn't quite turn out that way. But I just wondered, when you see prices again getting back to those levels of around $34, are we about to lose get this lost decade that people are talking about, you think?
Yeah, no, there was definitely some optimistic expectations for prices after the recession, and there were some really good reasons for that. You know, we did see significant changes in policy developments in China that could have limited supplies from one of the world's largest producers. That seems to have slowed, and I pointed out that earlier that some of that could be to this kind of global opposition that we've had in the market. I do think a lot of that was more supply related than it was demand. You know, we did see the demand continue to perform not too far off than expectations, because we had the really kind of robust rebound in 2010, and demand holding up, you know, better than one would expect with the, you know, softer economic conditions in 2011. So some of those supply concerns have come off. I think that for prices to get back up to, $34, we would need to see some type of a supply shock that would contribute to that. Right now, I don't think that's in the cards just yet, because, you know, there is some excess supply in the market, but I guess it's always a high case scenario, but it's not part of our base.
Can I maybe ask a question as well? When prices last ran up, one of the issues was a bottleneck in roasting capacity. With new production coming on, is there enough roasting capacity to cover all of that?
There has been some expansions in roasting capacity. There still lies some questions of whether or not some of the idle capacity in China would come back on to roast material, and whether or not they would be a toll roaster. I don't think that that's going to be the case for the next, at least until maybe 2013-14, whether or not it's going to be an issue. Particularly at that time period, some of the concerns were whether or not there was enough roasting capacity to handle byproduct material, which has lower grades than the primary material, you know, that they use to blend to process. So it could become an issue, down the road if there is not continued expansions for byproduct producers, much more than for primary.
Any further questions? No? In which case, I thank you once again, Catherine, for that excellent presentation.